$730 billion. That's how much market value disappeared from US stocks in just one day. Investors woke up to a blood-red trading screen as the S&P 500, Nasdaq Composite, and Dow Jones Industrial Average all slid sharply. The sell-off started in technology and artificial intelligence-related companies, then rippled across the entire market. For months, analysts have been warning that valuations were stretched, and now those warnings seem to be catching up with reality. Reports from Goldman Sachs and Morgan Stanley calling parts of the market overheated only added to the fear. At the same time, new data showing weaker job growth and a wave of corporate layoffs hit confidence hard. Within hours, billions in paper wealth evaporated. It wasn't just numbers on a screen, it was a wake-up call that even the most powerful bull runs eventually pause. So, what's really behind this sudden slide? Three forces are colliding. First, the technology and AI boom that drove this year's rally has reached a saturation point. Many of the biggest names are priced for perfection, and when growth slows even slightly, prices react violently. Second, the economy is sending mixed signals. Job cuts are rising, consumer sentiment is weakening, and the lingering US government shutdown has delayed official data, leaving investors flying half-blind. Third, the market is shifting from risk on to risk off. In plain English, that means investors are pulling money out of risky, high-growth assets and moving it into safer areas like utilities, healthcare, and cash. This rotation isn't panic, it's survival. When uncertainty rises, the first instinct is to protect gains. Put all that together and you get exactly what we're seeing now: volatility, hesitation, and a search for new footing. Beneath the headlines, three deeper forces are colliding. First, overvaluation. AI stocks are trading at price-to-earnings levels not seen since the dot-com era. Second, economic cooling. After months of strength, the labor market is showing fatigue. Hiring freezes, budget cuts, and falling retail demand. Third, rotation. Big investors are quietly moving money from high-risk growth stocks into safer corners like healthcare, utilities, and bonds. It's not fear, it's repositioning. But when the largest funds rebalance at once, the impact can shake the entire system. This isn't just about charts and tickers. There's a human story here too. When markets tumble, 401ks shrink, retirement plans wobble, and everyday investors feel the pressure. People who entered the market during the AI boom are seeing their first real downturn. Some are selling out of fear, others are holding on, learning what volatility truly feels like. Economic anxiety is spreading. Companies tighten budgets, hiring slows, and confidence in spending drops. A market correction often ripples far beyond Wall Street. It touches homes, jobs, and real lives. For investors, what's happening right now is more than a market story. It's a reality check. The headlines say billions wiped out, but what they don't say is that corrections are how markets breathe. Prices rise on optimism, but they reset when reality knocks. This isn't about panic, it's about perspective. When we look back at moments like this, they almost always end up being teaching points rather than turning points. The first lesson is that market value is not the same as real loss. If you haven't sold, those dips on your portfolio screen are unrealized. They can recover, they can even grow stronger, but only if you resist the emotional urge to sell into fear. The second lesson is diversification. When one sector, like tech or AI, becomes everyone's favorite, risk quietly multiplies. Putting all your chips on the same table might work for a while, but when sentiment shifts, the fall is steep. A well-balanced portfolio with exposure to sectors like energy, manufacturing, healthcare, or even emerging markets can soften the blow. Because history shows that while tech leads the charge, it doesn't always lead the recovery. The third lesson is about time horizon. If you're investing for the next quarter, this volatility feels brutal. But if you're investing for the next decade, it's an opportunity. Corrections pull prices back to rational levels, and that's where real value begins to appear. Long-term investors don't chase the trend of the day. They position themselves quietly while everyone else reacts loudly. And the final lesson, stay curious, not complacent. The market's rhythm changes every few years. New technologies, new policies, new global pressures. Learning to adapt, question, and update your strategy is what separates survivors from spectators. This drop may sting, but it's also a reminder. No rally lasts forever, and no fall does either. The coming weeks will be critical because they'll reveal whether this was just turbulence or the first sign of a longer storm. Every investor, analyst, and policymaker will be watching a few key indicators. First, corporate earnings. The big tech and AI firms that carried the market this year will release their next report soon. If revenues keep growing and margins hold up, that could restore confidence. But if guidance turns cautious, if executives start talking about slowing demand, tighter budgets, or delayed contracts, expect selling pressure to intensify. Investors have priced these companies as if growth will remain explosive forever. Any hint that growth is plateauing could spark another round of declines. Second, jobs and wages. The labor market has been the quiet backbone of the U.S. economy. Even when inflation rose, people kept working, spending, and borrowing. But now, we're seeing a shift. Hiring freezes, especially in the tech and financial sectors, and a slowdown in wage growth. If job data weakens further, it could ripple across consumer spending and confidence, deepening fears of a slowdown. Third, monetary policy. The Federal Reserve's next moves matter enormously. If inflation data shows signs of cooling, rate cuts could return to the conversation, a potential spark for a rebound. But if inflation sticks and the Fed keeps rates higher for longer, corporate profits will feel the squeeze. That tension between cooling prices and borrowing costs will shape every market decision in the months ahead. Fourth, global pressures. Keep an eye on international markets, from Europe's sluggish growth to China's ongoing slowdown. When global demand weakens, it pulls the US down with it, no matter how strong the domestic data looks. And finally, watch market breadth. When only a handful of tech giants drive the market, it's a fragile rally. Healthy markets have participation, hundreds of companies moving upward together. If the next rebound looks narrow again, it might not last. In short, the next few weeks are the market's stress test. Will it stabilize and rebuild confidence, or will the cracks widen into something more structural? Nobody knows for sure, but the clues are about to surface. In the end, what we're witnessing is not just a correction, it's a cultural moment in finance. For nearly 2 years, artificial intelligence has dominated headlines, valuations, and investor dreams. Companies with little more than an AI-related press release saw their stocks double or triple overnight. The world fell in love with a new story, one that promised to change everything. And while that story may still come true in the long run, the market is reminding everyone that innovation and profitability are not the same thing. This pullback is separating excitement from execution. It's asking the hard questions. Which companies have real earnings power? Which ones just have buzz? Every generation of investors goes through a reckoning like this. .com, crypto, housing, and now AI. Each time, the hype burns off and the substance remains. So maybe this is the healthy reset we need. Not an end to progress, but a recalibration of expectations. On a larger scale, it also shows how interconnected everything has become. A few cautious words from bankers, a disappointing job report, and algorithmic trading systems turn ripples into tidal waves. That's the new normal: speed, scale, and sensitivity. For individuals, it's a reminder that financial literacy is not optional anymore. We live in a world where headlines can shift markets and markets can shape livelihoods. Understanding the basics, valuations, inflation, diversification isn't just for professionals. It's survival knowledge. And for all the fear, there's still resilience here. The U.S. economy remains innovative. Corporate balance sheets, while strained, are not collapsing. Investors are cautious but not fleeing. That's how markets evolve, through corrections that restore balance, trust, and perspective. So when you hear that $730 billion were wiped out in a day, remember, the number is dramatic, but the story isn't over. This is a pause, not a full stop, a reminder that growth is earned, not given. And in that space between panic and patience, the next opportunity always begins.